Okay, let me start. Good day to one and all. This is Dr. Sivaram of iknowindustries.com. During that of the European session, I was giving the Tracking Live the Forex Market Together Part 1 webinar from 9 GMT onwards. During that process, during the webinar time, I explained to you my trading system, how simple it is in order to track the market using the live market code page, and also fine-tune the forecast using the market reading technique, noting down the initial lows and the highs, and subsequently find out in which way the players intend to make the moves in the market. Accordingly, we take our trading decisions. Now, we are in the part 2 of the webinar. During part 1, I had taken some positions, and I like to show you what happened to those positions, or to the limit orders what I have placed. And also, I will explain to you more about the trading strategy during this particular part 2, and also try to explain to you what trade we can do before and after FOMC interest rate decision and the press conference. Now let us move to that of the trades what I have just suggested during that of the early European session. So during that of the European session, I was explaining to you that euro was holding above that of the initial high for more than 2 hours, and the players intend to make the higher level consolidation, and still you come across the same high 1.0639 as the high, and the low was 1.0619. I just breached the low during the early part of the US session, started gaining the level. That is why I suggested that we can keep about 4 pips below that the buy limit order. So that particular order is being filled. And you know, the spread in the case of euro is hardly about 35 pips. In that, market was above that of 1.0619 during that of the European session. So there was no trading opportunity, but we envisaged to do the trade during that of the US session because of the FOMC announcement to be by 8 GMT. Traders are keeping away from that of the market, so the players are also making small swings. But we are not afraid of the market, which way the market is going to move during that of the FOMC interest rate announcement, and also during that of the press conference. The way in which they are holding it indicate very clearly that they wanted to make an intentional move on the upside. The forecast is also telling the same. So on that basis, I had taken the euro position and kept the exit order near that of the high and the sell stop or the hedge order at 1.0585. Then in the case of GBP, I kept above that of around that of the initial high 1.2165, 1.2167 was the high. I just kept 2 pips below that of the initial high, but the market did not come down. So actually it came down to 2187 and then started gaining the level, and they are not dropping it and still holding above that of the initial high. So we will try to modify the level to that of 89 because they came up to that of 87 in the bid, but the ask was 89. Below that they are not dropping. So we will try to keep the limit order there, and accordingly we will keep modify the hedge order also 30 pips below. So it will be 59. So why we are doing it? Because they are not dropping more, they are simply holding it. And in first 30 minutes of the US session from 13:30 to 14 GMT, they are not really making a drop. So we are trying to keep only about 2-3 pips below that of the current market level in order to take a buy position. And similarly, in the case of yen, they did not go to 114.90 and they are holding around 80, 79, 80 level. So we'll also modify there in the case of yen. So just 10 pips, I lowered it after watching throughout the European session when they are not filled it. So now they will fill it because it is almost close to that. Then once it is filled, it will become a position. In the case of Australian dollar also, they did not make a drop and it was holding around the top. 81 was the initial high. They are holding around that of 90. So we will try to modify the level as 87, just 3 pips below that of the current level, in order to see whether they will give a definite fill for us. Then we will keep 57 as the hedge order. So excepting euro, no other order was filled. They were all limit positions only. So currently they have filled it, even though I just placed the order during that of the European session. It was not at all filled in all. So I just made the modifications slightly about 5 to 10 pips away from that of the current market level, so that I'll get a definite fill. And we have noticed that they are still holding above that of the initial high in all the currencies in order to make US dollar weakening move during that of the FOMC interest rate decision time. I'll just save it. Okay. So if you've got any doubt, you can ask me over the question answer window. I'll be willing to answer the questions. Meanwhile, I'll explain to you, for the benefit of those who have joined the webinar now, how exactly my trading system works. So my trading system consists of 3 components, namely the derived forecast, which is used in order to find out in which way the players are expected to make the moves in the market for a longer time frame as well as shorter time frame, so that we will be able to get the session-wise forecast and also during the week in which way they are going to make the moves. And that I give it in the form of the expected market moves for the entire week on Mondays during Asian Session Live Market Analysis webinar, which I give it between 5 and 5:30 GMT, and that is being recorded and displayed in FX Street as well as in YouTube. You can always have access to that and get it free, the expected market moves. And today, during that of the European session, they were expected to make a swing and slide. Because of low volume, the slide was not very significant. And they are expected to make now during that of the US session from 13:30 onwards. So from now it is 13:30 to 20:30 GMT. By mistake, it is mentioned as 34. 1 minute. So they are making the swings near still above that of the initial high, and they are expected to slowly gain the levels. So at that time from 13:30 it is now 14:10. So already 30 minutes passed from the start of the session. So they are expected to gain the levels and show the US dollar weakening move. Then for that, in order to get it confirmed, I showed you the initial lows and the highs noted down around 3:30 GMT. And in the case of Euro, they are holding closer to that. And in the case of GBP, still above this. This was the level I was keeping the buy limit order. They did not fill. And in the case of GBP also, they did not make any upward stop. And now we got the definite fill in the case of USD Yen, 114.80. Then in the case of CHF also, they are making only a small swing. So after noting down the levels, now USD Yen has become a definite fill. I will change it from sell limit to sell position. So I showed the forecast and also explained to you the market reading. So we note down the initial lows and highs around 3:30 GMT. They start setting the lows and the highs between 2:30 and 3:30. So by 3:30, we'll be able to know the initial lows and the highs set. And this, the players use it as a referral levels. And from there, they are trying to use it for their specific market operation purpose. So let us not go into the details of it, but the same initial lows and the highs we note down and try to compare the market where exactly it is from time to time till end of the day. Thereby, we are able to make a market reading with the help of the type of moves. So I explained to you the type of moves which are quick in nature or the stop-ins, false moves, and extended move. A stop-in is a move which happens for less than 30 minutes. They do it during that of the early and the late sessions. Early and the late sessions. Now the US session starts by 13:30 GMT. During the early session, they make a brief downward or upward stop-in. And the opposite move will be seen during that of the session. So one can easily identify when they make a downward stop-in, then we can confirm that by end of the session, they are going to make a rise. Whether it is FOMC or anything or any speech, etc., still they intend to make a rise. They may create uncertainty by making small dip in one or two pairs or in some currencies like GBP in order to create the sentiment, but then they will make a definite move towards close opposite to that of the initial move they do it during the early session. Now in the early session, when they are making a dip in the case of Euro and GBP, which clearly indicates that they wanted to gain the levels. So this way we try to read their intentions. Then they make the false move during that other gap time. So gap time move, you would have noticed that they made a quick firm up move in the case of Euro and GBP. Then it is a false move because they went up to the high or closer to high, but they did not breach the high and then started making the slide. So that is referred as a false move. The false move is the one, they go up to the initial high and then start making a slide, or they go up to the low and reverse. So that is referred as a false move. Then you come across another move, which is also a quick move, namely extended move, which happens for more than 2 hours, 30 minutes, up to 2 hours. So here again, first 30 minutes, they will make a very quick move and start holding it for 2 hours near the high or near the low and induce the traders to commit positions. but they will be doing opposite. When they hold high, we'll be thinking that they are holding the market to make a rise, but they hold high and book profit with that of the emotional buyers at the higher level. So when they drop and hold near that of below that of the low, that means they wanted to hold low and buy. But it will appear that any level you keep the uh, by order, they are giving a definite fill, but it is not like that. They hold low and they try to buy, and for that, they just make a small dip, one pip dip, and hold. And when the sell orders come, then immediately they grab all the sells. Again, make a dip and hold. That is how they do it. So that is why between that of the initial high and the new high, or between that of the initial low and the new low, they try to make the swings and grab all the positions. Those who are selling at the lower level, they will absorb it, or the stops they will absorb. Similarly, those who are selling above that of the initial high and the new high, they will absorb. Then they will just distribute and then make a dip and again buy, and alternatively they do it. So these three moves are called as the quick moves or the false moves. They quick moves or false moves because they quickly gain the level without making a high level buy in order to distribute. They quickly drop without making lower level sells in order to accumulate buy positions. So this they do it with the help of a trick in the banks. Those who are associated with the banks will know about it, how exactly they quickly make upward and the downward spikes. Then you come across the intentional move, which is a slow move. They hold and then pip by pip, they just make the move. And every 30 minutes, they either cut the new high or new low and continue to make the move and absorbing all the cells while rising, or distributing the cells while dropping. Because after making a pip by pip drop, they hold at the lowest level and induce all the people to liquidate the long position by weekend. So either they rise all the levels and hold high during the weekend and induce all the short sellers to go in for short covering. So in that, predominantly, we need to find whether the traders are long. When the traders become bullish and they try to take buy position following that of the fundamentals, then later on the players drop the market using some excuse and induce all the traders who have taken the long position at the higher level to liquidate. And when their traders see that, when they are traded without the stop and the market is really moved about 100 pips on the downside, they become really jittery and liquidate the long position to see that the players gain back again the levels. So this is what happens in the market, one needs to understand. Then the swing is the one, they do it near that of the high like this for about 5-10 pips or 20 pips, or sometimes near that of the low when they are accumulating position, or between the high and the low before that of the data release or during the mid session. They hold euro near that of the high and hold GBP near that of the low. That way they try to make the swings without breaching the high or the low, and that way they handle the crosses. Besides, they do another type of move which is referred as the extended stop and move that happens for about 150 pips on the downside, and they reverse it within the same day or within the same session using some other excuse. They quickly drop the market and reverse and slowly buy and rise the market and go above from where they started and continue to gain the level. This they do it during the trend reversal time. So these are all the type of moves one need to understand, and also try to relate it to that of the time frame what they are using it. Now because of the daylight saving system from this Sunday and from Monday onwards, the market is, your session starts from that of 13:30 GMT, ends by 20:30 GMT, and 20:30 to 0030 GMT of the next day is the gap time before the start of the next day. During that time, the interest is charged to that of the open positions, and then they continue to make the moves for the next day. If you got any doubt, kindly ask me. I am willing to answer those questions. So what we do, we note down the initial lows and the highs and find out whether the market is near that of the low or near that of the high, and also see the net change, whether there is a significant change in the net change. And normally, if the spread between the low and the high is more than 40 pips, we try to initiate taking positions in a currency. When the spread is less, then we avoid taking it, because the holding time of the position will be long and it might test our patience. Then the net change is nothing but the current market level when compared to that of yesterday US session close. So that way we are able to find out from that of yesterday US session close, Euro has gained about 13 pips, GBP has gained about 44 pips, etc. And when it is in green, we understand that it is in positive level. When it is in red, it is in negative level. That is lower than that of yesterday's close when it is in red. When it is in green, it is higher than that of yesterday's close. Now we'll go to the trading strategy. When we use stop instead of the hedge order, the hedging facility should be available in the trading platform. Then we can use the hedge order. And when we use the hedge order, what happens when the market moves against us? In the event when the market moves against us, the position becomes hedged. So we fine-tune our entry and try to take the position. So it is most unlikely we might be hedged. When you are able to keep stop at entry and remove the hedge order, then even if the market comes down against us, then our position will be closed without profit or loss. Then we can think about new trade. So there comes your quickness. So once the position makes about 15 to 25 pips profit, then immediately keep stop at entry, remove the hedge order. When you are not able to remove the hedge order, when the market is consolidating and sluggish, and suddenly when the hedge is being filled, then we need to watch for about 10 to 30 minutes to find out whether the hedging is making profit or not. If the hedging is not making profit, we have to simply close the hedge order with 1 or 2 pips loss. We have to watch for 10 to 30 minutes, not unlimited. 10 to 30 minutes we have to watch. If you are a skillful trader, within 10 minutes you will be able to understand the hedging was filled during that of the stop end. Only when it is filled during that of the stop end, we close it with a small loss or we stop at entry and then keep another hedge order to limit the risk, and then we trail or keep stop at entry and remove the hedge order. Now you can see that slowly they are gaining the levels. So this is what you need to understand. Then, so during that of the early session, between 13:30 to 14 GMT, when they are making lower level swing, they do it during that of the early session. Sometimes they do it within 30 minutes or up to 1.5 hours here. So that we need to watch and then try to take the positions. So now they have finished it in about 1 hour, started gaining the level slowly, and they will not retrace the drop, and they will simply pip by pip gain the levels and hold the market. So that when the market makes small swing, the scalpers will try to enter into the market. What they do is whenever there is a firm up move, they try to sell, and when the market comes down, they will buy back in 5-10 pips. Again, they will try to take a buy, and when the market goes up, they will book profit for 5-10 pips. So that way, the scalpers aiming for about 2-3 pips or 5 pips, sometimes 10 pips, They try to continue to enter and exit. And invariably what happens when the profit is only about 5 to 10 pips, they increase the quantity of positions. Instead of taking one mini lot or one standard lot, they will try to take about 5 standard or 10 standard lot when the leverage is very high, so that they don't block much of an equity. And then they try to close it with 1 or 2 pips or 5 pips profit, so that that might give about $100 to $200. So invariably they go in for such type of trade. But if the market suddenly spikes up, they are caught unaware, their account will be closed. So always avoid doing scalping that will make you highly impulsive. And once you become highly impulsive, you might get the nervous disorder and you will not be able to perceive the market properly. My humble suggestion is market rewards patience. So if you patiently trade, look for a great opportunity and then enter into the market. If you miss that opportunity, then always tell yourself that market keeps giving opportunities. Wait for the next opportunity and then try to take. Ultimately, we have to earn money from that other market without losing the earned money. There comes our skill set. Focus on that. So to watch for 30 minutes from the start of the market, and when the low is not being breached, you try to take a buy position near that of the low, and then afterwards keep 30 pips hedge order to limit the risk. When the position is not hedged and the position start making profit of 15 pips, keep stop at entry and remove the hedge order. See, now you can see that slowly they are gaining the levels. We have got only Euro and USD position. GBP we could not take it. Anyhow, doesn't matter. It is only mainly to show how we fine tune our entry. It is not that I need to make profit in a demo account or in a paper trading. Instead, you need to understand the trading psychology. That is why I'm just explaining more into that of the method, rather than simply taking a position and making emotional cry and things like that. Then exit out of the position near the high or 45 pips away from that of the entry, because normally they make such moves 45 pips. You should be able to close it with a profit. The going is good, where the momentum is good, then you can keep 75 pips limit order to close the position. Or sometimes if the high is far away, more than 75 pips, then you can keep there the exit order. They are likely to go up to that of the high and take out the stops there and then start distributing the positions. So they are not anyway bullish or bearish. They create the bullish field, and whatever the buy positions they have, they distribute to that of the traders. They create the bearish field and accumulate against their sells at the lower level after dropping the market. So they keep on doing the trades. They are least bothered about whether euro has dropped so much or JPY has dropped so much, etc. So ultimately, they are interested in making money out of these, and they don't have any sentimental attachment to any currency pair. So I request all the traders not to have any sentimental attachment with any currency pair, and should not think that no, euro is my country currency, so I should not sell it. So don't have such things, because these are all nothing but the ratios. It is not the actual currencies. They are ratios, leveraged ratios. And these ratios only we are trading it. So avoid creating or developing sentiment towards any currency pair that will make you biased. Then in the event when the position is hedged, suppose you take a buy and the market has come down and filled your hedge order, then you need to watch for 10 to 30 minutes. If the hedging is making loss for 10 minutes, if you become a seasoned trader, within 10 minutes you will be able to judge whether it was filled during stop end. Normally the stop end is for 30 minutes. So you wait up to 30 minutes. And if if the hedge is not making any profit, you simply close it with a nominal loss of 1 or 2 pips, or we stop at entry and keep another hedge order to limit the risk 30 pips below. And once the market start moving upward, you can raise the hedge order to the earlier level until you are able to keep stop at entry in the position. Then you can remove the hedge order. And that way, you find the hedge is used to limit the risk and it is used instead of stop. So that we are able to limit the risk and we will not take unlimited risk with regard to the positions. Then, if the hedging is making continuously profit for more than 30 minutes, you know very well, either they are doing extended move or intentional move. In the event they are doing extended move, in 2 hours time, you'll be able to find that the hedge is making profit. Afterwards, the new lower level is not being breached after 2 hours. Then you know very well it was extended move. They wanted to gain the level upward to show the intentional move as a follow-up move of the extended move. At the time, book profit in the hedge and keep another hedge order to limit the risk. And once they start gaining the level, you trail the hedge order upward until you are able to keep stop at entry. There are certain knee-jerk reactions. Sometimes you find that suddenly somebody might die or there might be some natural calamity, etc. Then the market might go in for a distress selling or distress buying and things like that. In such a situation, when you are hedged and the hedging is continuously making profit for more than 2 hours, then close your original position, buy position. You might be closing it with 70 pips loss, but the hedge you will be making already 40 pips profit. So still you will only lose 30 pips. And then subsequently, if the market goes down another 30 pips, you are at break even. You can close it and come out of that without any issue. Or if you want to maximize the profit, use a trailing stop in a profit making position and let them come down in a distress condition. You can maximize the profit on the sell side and close it using a trailing stop and trailing take profit order. That way, you will be able to do either way trading. So you can understand in the event if the market goes against, still we will not spend our time in telling that the forecast has gone wrong. I am extremely sorry and things like that, because that is not going to help in building that equity for us. So immediately we have to become quick-witted. We should be in a position to grab the profit other way, because there are only 2 possible moves in the market, either on the upside or on the downside. So we will be participating both on the upside move and on the downside move. There lies your skill set. It is something like your car has got a reverse gear. So when you are following in the traffic, suddenly you find that there is a traffic jam. Then immediately you use your reverse gear and turn the car in the opposite direction and just go away from that of the traffic jam. So if needed, you use it. So you need to know when it is needed. There comes your skill set. When I have to reverse the trend. So the simple method is beyond 2 hours, they continue to show the profit in the hedge. That means they are making intentional move. It will be for 2 sessions and the start of the 3rd session. Till such time you can hold the hedge position, close the original buy, hold the hedge position and maximize the profit on the downside using a trailing stop. You should not miss that opportunity. Use your trailing stop so that when they suddenly reverse the market also, you should not be affected. That should not lead to any distress trading. And also you should be able to understand the drop is slow drop and not a quick drop. Quick drop means they might reverse. And if it is a slow drop, initially there might be a quick drop followed by that slow drop when it is happening every 30 minutes. Understand it is an intentional move. If you've got any doubt, kindly ask me. I'm willing to answer the questions. So we are not taking any fresh positions for the US session since we have already the positions from the European session carry forward. Our Euro position is making profit now, and our yen position is in profit. But market is making very sluggish move because of the FOMC meeting and that of the press conference. So the traders are keeping away, the players are making small moves in the market, just dragging the market and giving the impression to the traders that the market is alive. So near that of the FOMC interest rate decision time, around 18 GMT, will come across the market will make a false dip again. After gaining some levels, they'll make a false dip and give that impression that suddenly the market is going to collapse for the FOMC interest rate decision. By 18 GMT, the data will be out. Then they will make small swing and wait for 18:30 GMT press conference. Then the press conference, they will try to give interpretation, whether they are hawkish or dovish and whatever it is. They try to give various type of interpretations, and sometimes they give counter interpretations also, and then make whips or moves in the market. But they are expected to make an upward spike, and from there they might make a downward move little bit in order to book profit and then continue to gain the level, sell their buy position, book profit and continue to gain the level. That is how they do it in the market. That is why you find market gains about 70 pips, then drop about 20-30 pips, again gains about 50 pips, and then drop about 10 pips. That is what they do it, and you think that it is a chart pattern and things like that. There is nothing of that nature. The players try to find out up to what level the buy orders are there. They try to fill it. If there is any question, kindly ask me. There is no question coming up here. So either you are well versed with that of the information, or you are not able to follow anything. Only then there won't be any question coming. I presume that you understood. So my contact details are given here. My website address, iknowindices.com, i-knowindices.com. I'm a PhD doctor. I had done PhD in applied statistics. And my email ID is dr@i-knowindices.com. My Skype chat, if you want to contact me over Skype and chat with me, then iknowindices@hotmail.com. Yahoo chat is also iknowindices@yahoo.com. My phone numbers are also given here. These are all the landlines and my mobile number. Then I'll come back by Friday and give the review part of the Asian session live market analysis. Since there are no questions coming up, so I'll wind up the webinar. I take this opportunity to thank FX Trade for the facilities provided to present the webinar. If you are benefited, I am very happy about it. I am not expecting any reward, but I want the traders to get rid of the market fear so that they will be able to really understand how the market is being manipulated, and that will give them the confidence that they can still earn money from the other market only by reading the intentions of the players and not by any indirect method. So wish you all the best in your trades. See you on Friday.